This is Quent Bilo commenting on a very important transition from Chapter 1 to Chapter 2, the way in which we record transactions. There's a dramatic change occurring here, which I cannot overemphasize. In Chapter 1, we used an equation analysis approach, meaning we looked at the effects of a transaction on the equation. Were assets affected, up or down? We used plus and minus. Was a liability position affected, up or down? On the other side of the equation, was an equity position affected, up or down? Speaking of the owner capital accounts. The equation analysis view used a table. This table gives us a 10,000-foot bird's eye view, if you will, demonstrating the elements of financial conditions staying in balance for every transaction that's recorded. The equation maintains an accountability. As assets increase on the left, there must be an acknowledgement on the right-hand side. Lacking this condition, this balanced condition, there's no equation. Here's a view of the Chapter 1 table that was used. We can see here that assets are listed on the left, individual assets, cash, accounts receivable, supplies, equipment, all of different natures. Right-hand side, liability accounts, such as accounts payable, meaning that we owe some party some money, and the owner's equity accounts, capital account, drawing account, revenue account, expense account. Just looking at the first transaction, we can read that as the owner has invested $15,000 into the business. Cash goes up plus $15,000, and we increase the owner's capital account $15,000, indicating as to the source of those assets. Keeping track of things in this manner allows us to see the changes to financial condition. Now, use of this table, though, is not an efficient method of recording transactions. A company cannot use this table method to record thousands of transactions an hour. It does give us a great view of financial condition. To emphasize, no transaction recorded unless it affects financial condition. Let's remind ourselves just what the definition of this is. It's the relationship between the elements of the formal accounting equation. That is, assets equals liability claims plus owner equity claims. Assets, things on the left, are items of value, wealth, that are owned or controlled by the business. Liabilities are items that are legally owed by the business, that is, a claim by a creditor. And owner equity is the net worth in assets after subtracting legal liabilities. It's what the owner claims after liabilities are subtracted from total assets. Looking at a diagram of our equation, assets on the left are wealth and where those assets came from. Either they were loaned to the company, or the owner invested or produced profits, which increase assets, and as profits are produced, we increase the owner equity. This is called building equity in a company. It's the owner equity category that's the most challenging for students, and we'll concentrate on this topic in later slides. First, though, just to indicate that it's a residual or leftover concept, meaning if we rearrange the equation, assets equals liabilities plus owner's equity, subtract liability from both sides, we isolate owner equity on the right-hand side. Again, it's the net worth or what's left over for owners to claim after liabilities are subtracted from assets. It's important to remember that the owner equity category includes profits in that section. Now, the creation of the accounting equation was a major shift in economic thought. The emergence of double entry accounting is a key for the precondition for capitalism, talking about private ownership of the means of production. Not just listing wealth or assets on the left side, but to whom this wealth is attributed to on the right side. Wealth comes about because it was loaned to the business. We keep track of that in liability accounts until they're paid. Or was it contributed by owners? Did they make an investment? Increase assets on the left, we increase the owner's capital account on the right to maintain a balance. Was wealth created by making sales? Sales will evidence that an asset was taken in, either cash or accounts receivable, the latter being a promise for a customer to pay later. Once a sale was created, we increase assets and we increase revenue on the other side under owner's equity. Or did wealth decrease due to incurring expenses? Expenses will reduce assets, and they also reduce the owner's equity category on the right-hand side. Now I want to bracket those last three activities. They're very important. They're what comprise the owner's equity category. Again, looking at those three elements of contributions by owners, investments by owners, or sales or expenses. You'll probably recognize that sales and expenses have a simple formula that is the definition of profit or loss. So sales minus expenses indicates our profit for the period. If expenses are greater than sales, we have a net loss. It's important to note that profit as a concept is a measurement of assets increasing due to sales, and expenses are a measurement of assets that decrease due to expenses. They're not the assets themselves. These accounts are a mere reflection of changes on the other side of the equation. They explain why assets change because of the profit-seeking activities of the business. As assets come in, we make an entry on the left. We also make an entry on the right explaining it. So sales bring in assets, increase on the left with a plus. The owner's equity category must increase on the right-hand side using a revenue account. Expenses reduce assets, and we also reduce owner's equity by using expense accounts on the right-hand side of the balance sheet. A short aside on double entry bookkeeping. This was actually considered a technology invented around the 13th century. It started with the creation of an account by Italian merchants. This is the focus of Chapter 2. An account is a distinct explanation of what's in a business, a specific asset, cash, etc., and maintaining reasons why and to whom these assets exist on the right-hand side. Left side assets, right side the reason side, creditor and owner actions. This is a very important moment in history. It separated the personal assets or wealth of the owner from those assets that were put into the business and controlled by that business. Chapter 1 calls this the economic entity assumption. Business activity is business. Personal is personal. Our focus is on the business. This is the accounting entity that we're keeping track of. The business becomes autonomous or independent, and double entry accounting is creates the to whom on the right-hand side the business answers to. The assets are under the control of the business, but the accounting equation creates a view of assets and those responsible for their existence. This is the double and double entry accounting. We need this to keep a balanced view of our entity. There's no small development. Bookkeeping developed in terms of recording facts about property and property rights. Property on the left, property rights on the right-hand side, also called claims. This created the equation, which is the context of all the activity we do in accounting. We maintain an accountability. And accountability is maintained on the right-hand side to ensure paybacks of assets on the left are made to the proper party. Either creditors who loan, they maintain a liability position, or the company maintains a liability position for creditors until they're paid off, or owners who invest and produce profits, part of the owner equity position. Different parties on the right side of the equation. Both have claims to assets on the left side. Okay, let's start with the use of an account. There are various accounts for assets such as cash, accounts receivable, promise of customers to pay in the future for work done previously, equipment, supplies, land, etc. These are all items of future value to the business. These are items in which we conduct operations. On the right-hand side, we have various liability accounts, notes payable, accounts payable. Any account that has the word payable indicates a liability. We owe some party. And then various owner equity accounts, capital account, expense account, revenue, and drawing account. So an account is an individual record of increases or decreases. The account is in effect as a storage container for a specific asset, liability, or owner equity item. It's a place to store financial information. For instance, taking cash alone, cash comes in, cash goes out. The account keeps track of the balance in cash at any particular time. The use of accounts evolved. Assets and liabilities came first, and profit and loss accounts came second, and lastly, the owner capital account developed It was at this point that the full accounting equation emerged, and with it, double entry bookkeeping. So reminding ourselves of the equation, assets equals liability claims plus owner claims. Let me shorten that. Assets on the left equal liabilities and owner equity on the right. I want to divide the equation here and simply introduce a left side and right side. We're going to come back to this as we develop our concept of an account. So left side, assets. Right side, liabilities and owner equity. We will assign unique terms to the left and right side of individual accounts which make up our entire equation. We have several accounts on the asset side and several accounts on the liability and owner equity side. But this positional location is the starting point. Okay, let's go back to chapter 1. We use the equation view. We kept track of cash coming in and cash going out. For instance, here we have an example of cash came in for $1,000. Another transaction, $500 increased cash. Then we had a decrease in cash of $300. Another increase, another decrease of $200 for a balance of $1,250. I'm just showing one side of an entry here, one account to illustrate our transition from chapter 1 to chapter 2. Chapter 1 focused on the intuitive plus or minus signs to show the effect on individual elements of our equation, and the dominance of increases over decreases, because logically the balance remaining is because we had more increases than decreases. We cannot deduct more than is placed into an item. So making the slightest of changes, taking those cash transactions, plus and minus, and simply separating them out into two columns. Pluses on the left, minuses on the right. We want to clearly see the effects of change by segregating two areas in the account, neatly aligning the changes of plus and minus. Let me add a line down the middle here. And now we see the development of what we're going to call a T account. The item of cash on the left now shows its changes in an account form, a two-sided account form displayed on the right. Let's make one other slight change. Let's remove the plus and minus signs. Now we still have a balance in the account because we have a dominance of entries on the left versus the right. It would become tedious and inefficient to have to label all such changes, plus or minus, as we record entries. However, we still need to clarify and differentiate each side of our entry. And so we're going to assign new labels, which will be universal to each account or storage unit, to set apart the left from the right. Now, accountants label the left side of an account as the debit side, and the right side of an account as the credit side. These are abbreviated DR and CR for debit and credit. The R in debit comes from a Latin term, debere. He was an Italian monk who documented this system. So in the cash account here, we'll say that we have a dominance of debits, and so we have a $1,250 debit balance because the debit entries exceed the value of the credit entries. Again, these labels are simply contrasting terms to be used on both sides of the equation for every account. What does debit mean? Simply left. What does credit mean? Simply right. So we've constructed an account segregating increases from decreases and naming each side, debit side and credit side. So the debit and credit, this new terminology, we should not think of it in terms of plastic debit cards or credit cards. Debit simply means left, credit simply means right. We should not pour meanings into these terms like debit as debt or credit as creditworthy. Debit simply means left, credit simply means right. Period. They're just directional signals for activity coming into the device known as an account, our T account. Left side, right side. Debit side, credit side. As we reflect on these changes to an account, we'll use these terms that any changes to the left side of an account means we are debiting the account. Any changes to the right side of an account, again, any account, we are crediting the account. Let's look back at our changes to our cash account. Now, it's important to note that debit also does not mean increase. Credit also does not mean decrease. Even though we may be able to conclude this based on our cash example here, it's just one example. We need to look at other accounts to see the design. Again, these labels are simply contrasting terms to be used for each account and on both sides of the equation. Debit meaning simply left, credit meaning simply right. Now, accountants describe this illustration as follows. The cash account was debited for $1,000. It was debited for $500, debited for $250. The account was credited for $300, credited for $200. These are all separate transactions. We have other parts of the journal that's not being displayed here. This just focusing on the cash account. So we have a $1,250 debit balance because the cash has an excess of debit dollars versus the credit dollars entering it during this time period. Is this a normal balance for cash on the left side, the debit side? The answer is yes. We'll call this a debit account. Let's look at another account to illustrate the change coming in here. We'll select the liability account, an account on the other side of the equation, used when taking out a loan. For this example, we'll display both sides of the entry. So the example here is a company takes out a $2,000 cash loan. Our treatment in Chapter 1 would display this change to financial condition as follows. The company gets cash plus $2,000, left-hand side, and the right-hand side, a notes payable account under a liability category, we'd say plus $2,000. Why do we have to record that notes payable? It must be repaid. It's part of our financial condition. It's a legal obligation to be paid later. So the context is an equation, so increase both sides to remain in a balanced view. Now, Chapter 2 uses the new account format to capture this event, which we'll look at on the next page. The same information is transferred to the account. So the cash account is debited for the $2,000 loan, and the notes payable account is credited for the $2,000 loan. Why the difference in treatment? On the left-hand side, in the asset cash account, we chose the left-hand side of the account. Notes payable on the right-hand side, we chose the right-hand side of the account to show increases. Each account here is increasing. If there are no other transactions, we say that the cash has a $2,000 debit balance, and the notes payable has a $2,000 credit balance. These are both considered positive balances. Both accounts have increased, different sides of the equation, different sides of the account, left side, right side. As noted, the accounts are simply on opposite sides of the respective sides of the equation. So here the debit to cash, meaning left, increased its value. And the credit notes payable, credit means right, increased its value. Any account on the left side of the equation increases with debits. And accounts on the right side of the equation increase with credits. I should say the categories on the right-hand side increase with credits. This left-right orientation combined with increases to each category, asset and liability respectively, has a design. Asset accounts on the left increase with debits, also meaning left. Liability accounts on the right increase with credits, also meaning right. To generalize that, all assets on the left-hand side of the equation will increase on the debit side, the left side. All liabilities on the right side of the equation will increase on the credit side, the right side. It's useful to focus on the increases to each category. That's the most intuitive. Assets accounts on the left increase on the left-hand side of their accounts. Liability accounts on the right side of the equation increase on the right side of their account. Let's bring in the equity category. The equity category in the equation is on the right-hand side. This category value in total increases with credits on the right-hand side of any accounts within that category. There's a consistency here. Now again, notice that the last phrase for equity, I use the term intentionally, category value increases with credits. Why did I use the word category, not individual accounts? Simply because the owner equity category has different activities flowing through it. We track 4 different activities under the owner equity category. 4 distinct activities. First of all, we track owner investments. We increase the owner capital account directly. If the owner invests cash on the left-hand side, we increase the owner capital account on the right-hand side. Expenses incurred. We use individually named expense accounts. Expenses incurred eventually result in a reduction of assets on the left-hand side of our equation, and we reduce our owner's equity on the right-hand side by decreasing equity. Another activity tracked through owner's equity, revenues earned. We use a descriptively named revenue account on the right-hand side and increase it as we make a sale entry, and withdrawals or takeaways by the owners, a divestment. We use an account called drawing that would decrease the equity side as the owner takes out cash on the left-hand side. So the equity category is indeed one to study and obsess upon. There are different types of accounts. Each reflects or mirrors changes to assets that are occurring on the other side of the equation. Here's a diagram that should be useful for your study purposes. All our asset categories on the left, and the other 2 categories, liability and owner equity, on the right. Wealth on the left, assets represent wealth, and the categories on the right represent claims or rights to wealth, not the wealth itself. That's on the left. So any asset account, left-hand side of the equation, increases on the left-hand side of the account or the debit side. As we debit assets, we say that we are increasing their account values. On the right-hand side, any liability account, if we increase it on the right-hand side of its account or the credit side. As we credit liability accounts, we are increasing their value. The equity category as a whole, which represents the net worth of the owner, any credit entries, the right side of accounts in the equity category, increase that category. Our expense and drawing activity, as we incur expenses or drawings by the owner, we would debit those accounts, which has the effect of decreasing the equity category. So expenses and drawings are contrary to the buildup of equity on the right-hand side of the equation. You see the design of the debit-credit rule. Debit left, credit right. Increases to each category is based on the left-right location within the equation. Now, the complexity of the equity category explains why in an earlier introduction to the accounting equation, and I refer to the expanded accounting equation, I abbreviate it as aloe vera. Assets equals liabilities plus owner's equity, and the vera portion of the phrase is a mnemonic or memory device detailing the 4 activities we just discussed that change the equity category in total. Investments increase it, expenses decrease owner's equity, revenue increases it, and takeaways or divestments to the drawing account decrease owner's equity. Just picture the other side of the activity. As an owner makes an investment, cash or some asset goes up on the left-hand side, and we increase the owner equity category by increasing the owner capital account with investments. As expenses result in reduction of assets, assets go down on the left, we decrease owner's equity on the right. As a revenue event occurs, it means we make a sale, assets go up on the left, either cash or accounts receivable, and we increase owner's equity on the right through the use of revenue account. Takeaways, the owner takes out assets. Assets go down on the left, we reduce the owner's equity category on the right through a drawing account. Looking at our equation, left side, right side, we name the left side of any account the debit side, the right-hand side of any account the credit side. Now, within the categories of assets, within the categories of liabilities and owner equities, we have separate accounts. So we have multiple T accounts on the left side, multiple T accounts on the right-hand side. The key question in use of the debit and credit labels are what accounts are termed debit balance accounts and what accounts are termed credit balance accounts. Why? To remember what account side increases it, also known as its normal balance. So assets would increase on the left side of an account. Its normal balance would be debits. All asset accounts are known as debit balance accounts. All liability accounts on the right-hand side of the equation increase on the right-hand side and are known as credit balance accounts. Owner's equity is a mixed situation. Some accounts increase on the credit side. Expenses and drawings increase on the debit left side. We would expect the credit balance to dominate in owner equity. A credit balance in the owner equity accounts taken as a whole indicate that the owner has a positive claim against assets on the other side of the equation. What's the mixture for owner equity accounts? As we just discussed previously, the owner capital account is a credit account. We increase it with entries on the right-hand side. It's the offset to the assets that the owner has brought in to the business. Expense accounts are called debit accounts. Expense accounts reduce owner's equity as assets are reduced on the other side of the equation. Revenue accounts are called credit accounts. Again, as a sale is made in cash or receivables are booked on the left-hand side of the equation, we increase the owner equity account through use of a revenue account. The drawing account is a debit account. It's contrary to the buildup of owner equity. As the owner draws assets out on the left-hand side, we reduce the owner's equity area on the right-hand side of the equation. Lots of different activity are measured in the owner's equity area. Let's study the association of the accounts left and right in this summary graph. Formula equation, assets equals liabilities plus owner equity. What increases assets? Debit entries increase assets. What increases liabilities on the right-hand side? Credit entries, right side of their accounts. What increases the owner equity category as a whole? Credit entries. It's important to recognize also where these accounts fall in the various financial statements that we looked at. Chapter 1 introduced you to a balance sheet. A balance sheet is a snapshot of financial condition at the end of a point in time, quarter end, year end. Total value of all ending assets. Liabilities are in that balance sheet, and also an owner capital position balances the balance sheet. The equity category is on the balance sheet as one number to balance it. The income statement accounts are included in the owner equity area. The revenue expense accounts are part of the change in owner's claim on assets. This review concerned itself with the transition from Chapter 1 recording to Chapter 2 recording transactions, where Chapter 2 uses accounts to collect change activity. This is a critical shift in thinking. It must be made to be successful in this course. We're not declaring plus and minus, we're declaring debits and credit entries to individual accounts. But that initial recording is not made direct to accounts. We have a first set of books called the journal. Once entries are journalized, then we transfer them to accounts in the ledger. Here's a simple diagram of that. Journalize first, debit and credit entries, balance journal entries, and we transfer information into ledgers. The same information that's in the journals and the ledgers, different sequence. Reviewing that sequence of recording, we have to first analyze the transaction and apply the rules of debit and credit to record the journal to begin with. So in our example of receiving a cash loan from a bank, we need to know that assets are increased with debits. Cash is an asset, and therefore the $2,000 debit to the cash account increases the cash account coming to the business. Notes payable, we have to know that's a liability account. Liabilities are increased with credit entries, and so we credit notes payable to show an increase in that claim on assets. That note payable will remain until it's paid off later. Note that we've indented the credit account notes payable. All credit entries in the journal are indented rightward, just as the credit entry is pushed to the right. Good form, necessary form. So once it's in the journal, we simply transfer information into the ledger. We transfer a debit entry, left-hand side of the cash account, and we transfer the credit entry to notes payable, right-hand side of the notes payable account. Again, the journal is a record of transactions by chronological date, and that same information is in the ledger, classified by account within categories of the equation. It's out of the ledger that we do all our reporting. And at a period end, we pull off a trial balance before financial statements are prepared. Why? To ensure all debits and credit accounts are still in balance. That trial balance is simply a listing of all accounts and their balances, debit or credit, to total debit dollars equal total credit dollars. It's essential to commit the normal balance of accounts, of any account, to memory. You must know this. Listed in the first column here, various account types and the side of the equation that it appears on. Asset accounts, liability, owner capital, revenue, expense, and drawing. So you can see the assets being on the left-hand side of the equation. They increase on the debit or left side. Their normal balance is a debit balance. All assets are debit balance accounts. How do you decrease an asset? Credited. Liabilities, right-hand side of the equation. They increase on the credit or right-hand side of the account. All liabilities are known as credit accounts. Their normal balance is credit. The owner capital account, right-hand side of the equation, increased on the right-hand side of the account. It's known as a credit account. Normal balance should be credit. Revenues, also, normal balance should be credit, increased on the right-hand side of the account. Expense and drawing, these are in contrast to building up equity, they reduce equity. So therefore, the normal balance on expense account would be a debit, just likewise a drawing. Reflects a reduction in assets that an owner has taken out. Expense and drawings counter or reduce the value of the owner's equity category. So the normal balance is the left-right signal that increases the value of the item. We just return to the location within the equation to judge which the normal balance of the account that we're dealing with. The wrinkle, as mentioned, are the expense and drawing accounts. Although they're both located on the right-hand side of the equation, they increase on the left-hand side of the account, but that increase on the left-hand side, that debit increase, reduces or decreases the equity category. Again, the equity category, we expect it to have a credit balance under normal circumstances. Just a listing of the common accounts: cash, accounts receivable, inventory, land, building equipment, prepaids, etc. On the left-hand side of our equation, they increase with debits. Debit means left. Accounts such as accounts payable, notes payable, any payable account, and unearned revenue is a liability account. Special situation of receiving cash before service or items are delivered. Time Magazine takes in cash on the left. It can't credit regular revenue. It'll credit unearned revenue until it delivers magazine. The equity accounts, right-hand side of the equation, we expect that to have a credit balance. The equity area increases with credits. The owner capital account, revenue account. Only the expense and drawing accounts will increase with debits on the left-hand side, which reduce the overall value of the equity category. Included a short example of journal entries, which we use in Chapter 2, just to indicate the recording of journal entries. The first example is the transactions of CPA sold services for $800, so it took in cash for $800. Why do we debit cash? Because cash is an asset. All assets increase with debits, we debit cash. The fee revenue, a revenue account on the right-hand side of the equation, it increases with a credit. We will credit fee revenue to show an increase in fee revenue. That fee revenue credit on the right-hand side explains why cash came in. Buying supplies. Supplies is an asset. Increase assets with a debit. How did we obtain those supplies? We paid cash. Cash was reduced. Cash as an asset is decreased with a credit. So a credit to cash and a debit to the supply asset account for that transaction. The others are self-explanatory. So let's take a peek at later chapter material. Accounts collect information. Just like an automobile's odometer collects or accumulates miles driven, autos also have a trip meter, which is resettable to zero to be used again after one particular trip. Most activity under the equity category uses resettable type accounts. That is, their activity at year end, and at year end only, is reset to zero. It's called closing out these accounts. We close them out with a journal entry. We transfer their balances to a single equity account, the owner capital account. So to summarize, certain account balances are reset each year. I've shown these in red, revenue, expense, and drawing. Their activity is zeroed out or closed out and transferred into the equity account, the owner capital account. These resettable accounts are called temporary accounts. Because the revenue and expense and drawings do their job during the current year, we want those reset to zero so they can remeasure items in the next fiscal year. The remeasurement is done anew each year, and therefore we close them out right at year end. So at the beginning of the year, they're all at zero to measure revenue and expense and drawings of the next fiscal period. All other accounts are called permanent accounts. All asset accounts, all liability accounts. The owner capital account is a permanent account. As we learned, the owner capital account inherits all the activity from the temporary accounts. The owner capital account is the only permanent account in the equity category area. So permanent accounts, their balances carry over to the next year. They are not zeroed out. In the company's balance sheet, we only show permanent accounts. Individual asset accounts, individual liability accounts, and a single owner capital account to balance the balance sheet. As mentioned, that owner capital account inherits the net income, revenue minus expenses, minus any drawings by the owner. So we've learned that there's many ways to look at accounts in this chapter. What category of the equation? Asset account, liability account, or is it one of the owner equity accounts? Either an owner capital account, expense account, revenue account, or drawing account. What financial statement do accounts appear on? Either the balance sheet or income statement. There's also an equity statement that we learned about in Chapter 1. The equity statement feeds into the balance sheet. The income statement feeds into the equity statement. The balance sheet is the permanent accounts, income statement, temporary accounts. Do balances and accounts carry from year to year? For permanent accounts, the answer is yes. For temporary, no. So as your study objective, you should be able to identify each account in the three manners listed above. You must spend some time in doing this. It's that important. I encourage you to review this PowerPoint as necessary to understand what's occurring in Chapter 2. This is a critical chapter. Using accounts, declaring debits and credits to accounts that reflect their activity for each transaction recorded. The rules of debit and credit, again, define what changes, either increase or decrease, are occurring in an account balance. It's not simply up or down, respectively, but both. Debit means both increase and decrease. Credit means both increase and decrease. Depends on the specific account and where it appears in the equation. This must be grasped now, not later. This is part of the language of accounting, which we must learn to move forward in other chapters.